Into something that's both fundamental and fascinating. Hey, good to have you here for this episode. Today, we're diving into something that's both fundamental and fascinating in economic analysis, the social accounting matrix, or SAM.
Yeah, it's one of those frameworks that, once you get into it, really opens up how you see the entire economy as this interconnected system. It's like a detailed ledger or map of all the economic flows happening in a country.
Exactly. And what's really powerful about SAM is that it captures the circular flow of economic activities, how money moves between producers, consumers, the government, and even the rest of the world. It's comprehensive, showing not just production, but also income distribution, transfers, savings, investment, and trade.
Right, and it's not just a snapshot of one part of the economy. It's a complete, consistent data system that integrates all these components into a single framework. That's why it's so valuable for economic modeling and policy analysis.
Before we get deeper, it's worth mentioning the historical roots. SAM actually originated from the foundational work on national accounts by economists Mead and Stone back in the 1940s.
Yeah, and then the first formal SAM was developed by Richard Stone, who, by the way, won a Nobel Prize for the UK in 1962. It was a big step forward in how economists could represent the economy in a matrix form.
And the concept really took off globally in the 1970s when researchers started applying SAM to developing countries, adapting it to different economic contexts.
So at its core, SAM is a square matrix where each row and column represents an account in the economy. The key principle here is double entry accounting, meaning for every account, total receipts, the row totals equal total expenditures, the column totals.
Yeah, that double entry principle is crucial. It ensures the accounts balance perfectly, which is what makes SAM reliable and consistent. It's not just about tracking production, but also about showing how income flows through factors like labor and capital, institutions like households and government, and even external trade.
And that's what sets SAM apart from simpler input-output tables. Input-output tables focus mainly on production and intermediate consumption, but SAM goes further by including income distribution, transfers, savings, investment, and the role of institutions.
Exactly. It links macroeconomic data, like national accounts, with microeconomic data, such as labor market and household statistics. So it gives a detailed socioeconomic picture that's both broad and deep.
Speaking of detail, SAM has some key features that make it stand out. First, full coverage. It covers all economic activities within the production boundary, including all persons and jobs. It ensures related variables are measured coherently, so important distinctions aren't lost.
Then there's harmonized concepts. Since SAM combines data from various sources and countries, it uses consistent classifications and concepts to ensure comparability and coherence.
That's so important because without harmonization, you'd end up with mismatched data that can't be reliably compared or integrated.
Right. Then there's consistency. SAM compilers adjust source data to satisfy strict accounting identities, so the accounts balance perfectly. This prevents users from making inconsistent assumptions or producing conflicting results.
And that adjustment process is transparent, too. The compilers document how they reconcile different data sources, which allows for public scrutiny and improvement.
Good quality data is another feature. SAM draws on multiple sources, administrative records, enterprise surveys, household surveys, to leverage the strengths of each and identify discrepancies.
That's a smart approach because each data source has its own strengths and weaknesses. By comparing them, compilers can improve the overall quality of the accounts.
Flexibility is also key. SAM can be extended to include additional details or satellite accounts, like environmental data, without breaking its logical structure.
Yeah, that adaptability means SAM can evolve with analytical needs, whether it's adding more sector detail or incorporating social and environmental dimensions.
Then there's timeliness. While integrating data might seem slow, SAM actually facilitates timely and reliable economic indicators by providing a consistent framework for updating estimates.
That's interesting because you'd think combining all these data sources would slow things down, but the integrated system actually helps produce early, consistent estimates.
Finally, transparency. The whole process of integrating and adjusting data is documented and published, which builds trust and encourages quality improvement.
So, to sum up, SAM organizes comprehensive information on a country's social and economic structure for a given period. It provides a bird's eye view of all flows of receipts and payments in the economy.
And importantly, it serves as a numerical foundation for building economic models to simulate the socio-economic impacts of policies.
That's a big deal, because policymakers can use SAM-based models to understand how changes in one part of the economy ripple through others.
Absolutely. Now, let's talk about why SAM is so important. It condenses the entire economy into a single matrix, making it easier to see interrelations between sectors and transaction categories.
And it supports what's called multiple actoring and multiple sectoring, meaning it can break down accounts by relevant units and classifications to analyze complex economic flows.
The matrix format is concise and mathematically tractable, which helps with balancing and modeling.
Plus, SAM reveals macro-level interrelations, like how household consumption links to production activities, or how government transfers affect income distribution.
And it captures transactions involving different types of units simultaneously: households buying commodities, enterprises paying taxes, government making transfers, all in one integrated framework.
That's a lot of complexity captured in one place. Now let's break down the main elements of SAM.
Sure. First, activities. These are the production processes within sectors like agriculture, mining, or services. Activities combine factors of production, labor, capital, with intermediate inputs to produce commodities.
And activities pay factors wages, rents, and profits during production. For example, a dairy activity might produce both milk and cheese, showing how one activity can produce multiple commodities.
Right. And commodities are the outputs of activities, goods and services. A commodity can be produced by multiple activities, like small-scale and large-scale maize production, both producing maize.
Commodities are valued at market prices and can be supplied domestically or imported.
Then we have factors, which are inputs to production, mainly labor and capital, but also natural resources like land and water. Factors receive income from activities and can be disaggregated by type or quality, like labor by gender.
Institutions are next. These are economic agents like households, enterprises, NGOs, and government. Unlike input-output tables, SAM includes detailed accounts of these institutions, showing income flows, transfers, taxes, and consumption.
Domestic non-government institutions include households and enterprises. Households own factors and receive income, pay taxes, consume goods, and receive transfers.
Enterprises earn factor incomes, pay corporate taxes, save, and transfer surpluses to government. Unlike households, enterprises don't demand commodities in the SAM framework.
Household consumption is interesting because SAM distinguishes between home consumption, goods produced and consumed by the household itself, and marketed consumption of commodities.
Home consumption is valued at producer prices, without marketing margins or sales taxes, while marketed consumption includes those.
The capital account records saving and investment flows, showing how resources are allocated for capital formation and stock accumulation.
And the rest of the world account captures transactions crossing national borders, like imports and exports.
Finally, government income and payments. Government accounts are disaggregated into core government and tax collection accounts. The government collects taxes, makes transfers to households and enterprises, consumes government services, and pays wages to factors.
That disaggregation is important because it clarifies the economic interpretation of payments, especially taxes and transfers.
To give a sense of how SAM looks, it's presented as a square matrix, with rows and columns representing accounts. Each entry shows payments from the column account to the row account, reflecting double entry accounting.
For example, activities pay factors for labor and capital. Households pay for commodities. Government collects taxes and makes transfers. The matrix format allows a concise and integrated view of all economic transactions.
So to wrap up, SAM is much more than just a data table. It's a comprehensive framework that captures the complexity and circularity of economic flows.
Its integration of production, income distribution, consumption, savings, investment, government, and external trade makes it invaluable for economic analysis and policy simulation.
And its flexibility and transparency make it adaptable to different countries and analytical needs, including environmental and social dimensions.
For experts, understanding SAM is crucial for building robust economic models and interpreting the socioeconomic impacts of policy decisions.
Well, that was a deep dive, but I think it really shows how SAM is a foundational tool for economists and policymakers alike.
Definitely. It's one of those frameworks that, once you grasp it, changes how you see the economy as a whole.
Thanks for joining me in this discussion.
Thanks, it was great unpacking SAM together.